Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Wednesday. It's October 5th, and the market's going to open up in about, let's see here, an hour and 18 minutes to be exact with you. Now, as you could see here, this is actually a really good example of what I've been trying to tell you guys for the last few weeks. Notice, U.S. stock market strongly yesterday, really strong. Reasonable data, bouncing back, ignoring negative data, and then global news comes out, and then here we are again. So this has been a trend for the last couple of weeks. The global markets, what's driving U.S. stocks lower, not U.S. stocks. So that's actually a pretty good sign, because if we get some stability from Europe like we got from the Bank of England buying bonds, that's a very, very powerful signal in the right direction. And that also gives us hope that the Federal Reserve will intervene. So again, but this is a perfect example. We close out beautifully last night, and here we are again down 265 points. What'll be very interesting today it'll be very interesting to see, and one of the things I'll be looking for is whether or not the Dow Jones and the Nasdaq gain back what they have lost overnight. If that happens, that means the U.S. markets are able to shrug off U.S. economy. Now, the only sector that I'm starting to see that in happens to be the Russell 2000. The Russell 2000 is shrugging it off real well. Matter of fact, look at it. We're almost at the upper end of this range. The Dow Jones went up to this range, which is really, really important. Now we're in the range, and the bond market, as you could see here, is still kind of flailing. That's a bad sign, and that's not making me feel warm and fuzzy. And by the way, I want to thank each and every one of you for posting comments below this video in the YouTube channel. It drives more viewers to our videos, and it allows me to spread this message across. So if you're liking this, we want more people to like it. Like this channel, subscribe to this channel, comment on YouTube. I will answer your question live on YouTube. I'm not kidding. I will do it. It takes me about 24 hours, but I'll do it. So go to WealthPress channel on YouTube, post comments. It's important to me. Anyhow, let's get back to this analysis. So Treasury notes are sideways. They're not really going down from this peak, but I'm very curious to see how they will end the week. And I'm really hoping, and I am hoping in this case, and I'm using the word hope, which I don't use often, is that they go back within this channel. Because if the Dow Jones is going back into this channel, but the bonds are not, that means there's the higher odds that the Dow Jones will also fall off. So again, there's a lot of vulnerability till we see the bond market. And I'm using the 20-year TLT. You could use the long bond, but they track each other. Basically, I'm looking for TLT to be above the 110 level. I really need to see it above the 110 level, or we're going to get more or we're going to lose more confidence as we go forward. Now, we've got some data this week. We've got the ADP report that's coming out in just a few minutes, maybe even out already. This is a private report that's going to reflect on Friday's employment situation. And Friday's employment situation is really, really, really important, because Friday's employment situation is the last employment report before the Fed decides to raise their rates or not raise their rates. You've got this and you've got the CPI, but this is the last monthly employment report, so it's very important to put this into context. And a lot of traders and investors are going to be watching this report, and they're going to be watching the ADP report and international trades in goods and services and the petroleum report. This is really big because OPEC is making stink again about lowering supply. There's been a lot of talk about it. Now let's talk a little bit about global economy so we could see what's been causing U.S. stocks to go down almost every single night, except for the last 2 nights. But this is a perfect example that you could see that global economy is really tanking U.S. stocks. It's not U.S. economy anymore, which means the U.S. stock market has fully assimilated all the crap coming our way from USA. Now it has to assimilate it all from Europe. Now, do you want to know why the Russell is outperforming everything? Because it has the least amount of exposure to international stocks and global economy like large caps do, right? They don't have as much credit and things like that. So it's a major factor. Now, volatility is declining. And if it doesn't come back up here, that's really good for us. And I'll go through technical levels, but I want to explain to you what's been going on through the world. European indexes fell in early trading, and U.S. futures were down as selling pressure kicked in Wednesday, again, after a few days of gains. But again, in Europe, not in USA. Asian shares advanced, led by a 6% jump in Hong Kong as markets there caught up after reopening. They had a lot of catching up. They were closed for the holidays. And that's another reason why U.S. markets weren't roiled. They weren't able to be roiled by Asian stocks because they were closed for holidays. Now, here's the good part. Oil rebounded from earlier losses with a cut in oil production on the table as OPEC oil-producing countries meet Wednesday. That's today. The OPEC alliance, including Saudi Arabia, Russia, is waiting a cut of 1 million barrels per day or more. They're trying to choke Europe out of natural gas. I'm telling you, it's very political. And I told you that energies were going to stay strong. On Tuesday, the Dow Jones climbed 2.8%, S&P 3.1%, NASDAQ 3.3%, but look at the Russell, 3.9%. Now, how long ago did Uncle Roger tell you that the small caps were going to lead? And they're still leading, and they're going to lead us out of here because they were the first ones to fall. Investors are watching closely as central banks raise interest rates to make borrowing more difficult and slow economic growth to tame inflation. Wall Street will get more detailed look at employment in the U.S. with a report on hiring by private companies. That's the ADP report that's due today, and I'll go through it right now when we're done with this. I'm just buying some time. And latest tally of weekly application for unemployment, that's on Thursday, and then the big government report, and then the CPI before the federal announcement, that's happening on Friday. So let's go here and let's see what the ADP number is. It'll be very interesting to see. I love doing these live. No, it still hasn't released yet, so far for private reports. But you could see here, they're looking for payroll growth from anywhere from 135,000 to 325. They're somewhere in between. And usually when the range is this big, that means they have no clue what they're doing. But as you could see here, it's 8:15, and the report is nowhere to be found. Let's see. Let's just try it one more time. Nothing yet. All right. Well, what can I do? I'll try it one more time before we're done. Let me give you some levels to pay attention to, okay? This is pretty important stuff. So right now on the Russell, the key, the big levels we want to pay attention to are right around the 178, 8-ish, 179-ish, actually 180. Let's just say 180. And you may want to write this down. This is IWM. On the Russell, 180. On the Dow, which actually penetrated through that lower, but I'm not holding my breath because the bond market's still really weak. If energy prices go up, this will really put the Dow in the right place. But for the Dow Jones, I just want to see us go to the 31,800 level. We're just above 30,000, which is good, but we haven't fully penetrated. Notice the bar is not completely above. So I want to see us in this world. Anywhere above 30,100, right around what would be really great if we can stick to 31.5, 32,000. That would be really great. And it'll be very interesting to see if the U.S. stock market can overcome this downside that's happening today. Again, let me now take you to the NASDAQ, the QQQ, give you some levels there. Yeah, see, we're in the zone now. So I want to see the next level of the 50-day moving average, which would put us at the 304 level. And on the SPY, let me give you that level. On the SPY, that level, again, we're already fully in. I love it. But I want to see us go to the 400 level or the 4,000 level on the SPY, if you will. Now, put the call ratio. Let's see how elevated it still is. Yeah, it's still in that zone. Nothing really changed too much. It's still in that zone. It's still elevated. It still hasn't come down. I'm hoping that the market is going to reflect on it. In terms of sectors, in terms of momentum, look at that. You have one stock breaking down on a 20-day breakdown and 57. So you don't have strong momentum. And remember yesterday I explained to you till this gets to about 4, 5, 6, 700, and same thing here. You don't really have too much overbought or oversold. So market is still very stagnant. There's still a lot more upside before we get overbought, which is why I wouldn't call the death of this rally just yet. In terms of sectors, nothing changed, and I'm not expecting anything to change for a while. Energy, healthcare, utilities, consumer staples. Notice consumer discretionaries coming down. Notice technology is down here. Remember I said nothing good's going to happen until consumer discretionary is back down here? It's making its way, and it will make its way because it just doesn't have any staying power with the rate hikes. I would definitely focus on energy, healthcare, utilities, and consumer staples over the near term. Folks, till this inflation is over, till the Fed starts stops this aggressive influx of interest rate hikes, till we have a deflationary environment, we may be in this time for a while. Now, top stocks. Today is Wednesday. Top stocks, healthcare, Lamb Weston. By the way, let me show you something interesting. I always show you guys something interesting, right? But check this out. If you look at the S&P 500 stocks, look at the leading stocks right now. Look at the pharmaceuticals. Look at how they're gaining. Look at pharmaceuticals. Where was that? Regeneron, look, near all-time high. Cardinal Health, look at that stock. So there's a lot of stocks that are breaking up, and a lot of energy stocks are making new highs too. So I am seeing more upside for some of these. So for my long pick, I would go with Lamb Weston. I like Lamb Weston. It's a good medical stock. I think it's basing nicely, and I think it's going to come up right now. A good stock. It's actually up right now $3 overnight when the Dow Jones is down quite a bit. On the downside, and I would if you're looking for options, I'll even give you options. Why not? I'm in a good mood today. Go to December and go to the 80 strike price. You can't really lose here. You got fine liquidity, open interest. To the downside, Charter. Now you may want to wait for this stock to go a little higher. I would say to the 3, maybe 70 area. But we're so oversold that there's not enough stocks that are going up for me to make a meaningful pullback to the downside just yet. I want to see a little more stocks making 20-day highs before we see that. Till we see that, I mean, 57 stocks, we're not done going higher yet. I don't think so. So I want to see it go higher, but I would wait for this stock to go to, let me just give you a good little trend line so you could see what I'm talking about. Go up to about the 400, maybe the 390 level. But right now, markets are really oversold, and they're coming off oversold conditions. So this would be the only stock I would be looking at selling right now. Now, folks, before I let you go, let's see if that report is out. Let's see if it's done. Let's see what the range is. 208,000, better than expected. So that's a little boost for the U.S. stock market. That's reflecting positively on Friday. But remember, if the report is too positive, that gives the Fed more ammunition to raise rates. So again, it's one of those times where if it's too good, it's not good. And if it's too bad, it may actually be better for the stock market. We're in a situation where worse data is actually benefiting the economy because it's causing the Fed to weaken their position in terms of raising rates. Now, folks, remember, comment below this video in the YouTube channel. I will always respond, I promise. Now, as you might have known, housing has never been more expensive. When you take into consideration average price, interest rates are not ultra low anymore, and income. We're at levels not seen since the 70s. And according to my colleague, Jeff Zananeri, this could trigger a 2008 level housing crisis. Oh yeah, it's like that. But it's not all bad news. He also sees massive investment opportunities for those that can position themselves correctly in the coming days. You don't have to take my word for it. Get the details from Jeff right now by clicking the link below. He'll explain what his research is signaling and how he's taking advantage of it. Click the link below to learn more, and I'll talk to you guys later. Remember, comment, feedback, and if you want personally ask me something, support@marketgeeks.com. My virtual door is always open for you. Bye, guys. Have a great, great day.